Yo, what's up? It's T. Welcome back to Money Sense. About a year ago, one of the craziest events in Wall Street history took place, which, of course, was the meteoric rise of GameStop. So today, let's look back at what took place and the fallout of the event. Let's get into it. For some background, GameStop is a physical game retailer that sells video games, consoles, electronics, and other small collectible items. If you know anything about gaming, you'll know that gamers aren't buying physical discs anymore. It's all about digital downloads now. Discs are more inconvenient to purchase, they scratch, they break, you lose them. Digital downloads are way easier for gamers. And as we see with the PS5's digital edition, gaming companies are realizing this too. In fact, it's better for the game console manufacturers and the game developers to use digital downloads. By eliminating the disk drive, it makes it easier to build a console and it's one less part that can break. And for game developers, the shift to digital downloads reduces game sharing and secondhand sales, which boosts their profit and sales. The only one who doesn't benefit from the shift is GameStop. With physical disc sales being a huge part of their business, this shift to digital could eventually spell out the end of their business. It's almost like there was another company that was in this position. I think they were in movies though? Nah. And investors on Wall Street knew this. Investors bet against GameStop's publicly traded stock using a method called short selling, and this is how it works. Imagine you're an investor, and there's a company you think is going to fail, or stock you think is going to go down. Short selling would allow you to profit when the share price falls. How it works is that you would start off by borrowing shares from a brokerage firm, and then immediately selling those shares into the market for, say, $100. Then, as you suspected, the stock price falls to $80. You could then buy back that stock for $80 and return those shares to the brokerage firm. And just like that, you've made $20. Short selling flips the purpose of the market, allowing investors to profit when the stock goes down instead of up. But you could also lose a lot of money if the price goes up, so short selling is extremely risky. If you simply buy a stock or go long, the most you can lose is 100% if the stock price falls all the way down to $0. But if you're short on a stock, your downside is theoretically infinite, as the stock price could climb forever and ever and ever. So when you have a company like GameStop, who everyone believes will be going out of business at some point soon, a lot of investors are going to short that stock, including the investment firm Melvin Capital. Remember that name. In fact, before its meteoric rise, GameStop had more short positions open than shares available in the market. And all of these short positions drove the stock to lows of under $3, and that's when Wall Street Bets stepped in. Wall Street Bets is a subreddit where people discuss their latest stock trades. This group is mostly known for their aggressive investment strategy, unique jargon, and their war against traditional Wall Street. This is a band of average Joes whose goal is to stick it to the man, the rich hedge funds and institutional investors who they think are ruining the stock market. You may hear this group referred to as the retail investor. Their broker of choice? Robinhood. Robinhood is a platform where investors can buy and sell stocks with zero commissions. Like the Wall Street Bets crowd, Robinhood also wants to make investing more available to the average person. We'll talk a bit more about them later. People on the Reddit group Wall Street Bets noticed just how many short positions were open on GameStop and took advantage by doing something called a short squeeze. A short squeeze works like this. You, an investor, have a short position in a stock, meaning you make a lot of money when the stock price goes down, but lose a lot of money when the stock price goes up. Remember, you borrowed shares, so eventually you're going to have to give them back. And if the stock price goes up, the lender is going to want them back even faster. When a short investor buys back a stock to give it back to his lender, this is called covering a short. When investors are forced to cover their short positions, it increases the amount of buy orders, raising the price of stock. And when the stock goes up, more investors are going to have to cover their short positions, which raises the stock price even further. And then more investors are going to have to cover their short positions. And it continues in this cycle until the stock goes to the moon. And this is exactly what happened in the GameStop scenario. The Wall Street Bets crowd convinced each other to buy and bid up the price of GameStop, and the short squeeze took place on a massive scale, resulting in one of the greatest events in Wall Street history. At the beginning of January, GameStop was priced at $17, and at the peak of the short squeeze, GameStop had reached over $500. One day, the price doubled, then came all the way back down again, and the stock went up 140% after Elon Musk tweeted about it. And it wasn't just GameStop. AMC and BlackBerry, who are in similar positions as GameStop, also had their prices skyrocket. And some people made a lot of money. Roaring Kitty, or Keith Gill, who was the originator of the GameStop short squeeze movement, made between 30 and 40 million on GameStop alone. And some people lost a lot of money. if you bought in at the top, you lost quite a bit. Remember Melvin Capital, the hedge fund that was betting that GameStop stock would go down? Yeah, they lost a lot of money. Almost half of it. They almost went bankrupt and they still haven't recovered. It's safe to say that Reddit won this round against Wall Street. But this is where the controversy starts. At Robinhood's highs, brokerage firms, including Robinhood, restricted trading, meaning you could sell GameStop stock, but you couldn't buy it. This, of course, tanked the price of GameStop, and it brought up theories of market manipulation. You see, Robinhood offers zero commission trading, which is what makes them so popular, but they gotta make money somehow. So they do this by using payment for order flow. To be honest, payment for order flow is very complicated, so I'll leave a link in the description if you want to learn more about it. But what it essentially boils down to is that Robinhood sends trading orders to a market maker who buys and sells stocks for them. And one of Robinhood's market makers and its biggest customer was Citadel, and Citadel had invested in Melvin Capital. So the theory is that Robinhood stopped trading of GameStop to artificially lower the stock price and save Melvin Capital and Citadel, which of course is highly illegal. And Wall Street Bets was mad. People thought this was extremely unfair, as no one should be able to manipulate the price of a stock to seek their own benefit. But there are also some on the other side that say Wall Street Bets also manipulated the market for themselves. Robinhood said that they restricted trading because of high market volatility, which may all well be true, but we needed a deeper explanation. The issue was brought to the United States Congress in a hearing that included CEOs from Robinhood, Melvin Capital, Citadel, and even some notable members from the Wall Street Bets Reddit group. There was a lot to learn and take away from this event. For one, we learned that we needed better policies to deal with market manipulation, payment for order flow, and investing in general. On a more personal level, remember that advanced trading techniques like short selling aren't always the best way to invest. Just ask Melvin Capital.
I am having a very bad day. I am in no mood.
But the aggressive investing and day trading of Wall Street Bets may also not be the best investing strategy either. One of my biggest gripes with the Wall Street Bets style of investing is that it treats investing as a thrill ride or casino instead of a real way to build wealth. This extends to Robinhood, who gamifies investing through prizes and cool graphics. But this is not a game. And one more thing to take away is that when you're making investments, try to avoid falling into the fear of missing out trap. If you're watching this chaos, it would have been pretty easy to feel like you should have jumped in so that you don't miss out on the gains. But if you're not careful, you might just jump in at the top and be left holding the bag. Use sound judgment and be careful not to let social media affect your decision making. So now, hopefully the GameStop saga makes just a bit more sense. So thank you guys for watching. Make sure to like and subscribe so you don't miss the next video, and let me know what you think by commenting down below. Also, follow the Instagram and TikTok at moneysense.t. I'll see you in the next one.